Thanks for clicking. Canada's banking regulator is flagging risks to the housing market stemming from a rise in mortgage delinquencies on behalf of those with variable rate mortgages. This according to the regulator's annual risk outlook, or as the media puts it. And yeah, as we'll see today, this could in fact be a sign of things to come. As the regulator notes, this rise in mortgage delinquencies are particular to those with variable rate mortgages with fixed payments. Those 60, 70, 90-year amortization mortgages that we knew could be a problem as far back as 2023.
Not a second earlier.
Given that, as we'll see today, these mortgages saw a major increase in their usage beginning 5 years ago from now, and then again in June of 2021, these delinquencies could very well be a sign of things to come. So what I want to do today is very briefly go over these mortgages, take a look at what OSFI is saying and what it's not, take a look at some of the supporting data, and then go over some implications. We do have a big couple of weeks ahead of us, highly consequential to the renewal wave, with Stats Canada set to release Canada's inflation data next week, and the Bank of Canada set to make its interest rate announcement and have a press conference soon thereafter in 2 weeks from now. We will obviously have an update out on both on this channel. Make sure you click like and subscribe if you want to get those updates. But for now, let's get into these variable rates. Onto these variable rate mortgages with fixed payments. Unlike those of adjustable rate mortgages, where the payment changes when the Bank of Canada lowers or raises interest rates, with these VRMs, the only change is how much goes towards principal and how much goes towards interest. As such, when interest rates rise, the payment stays the same, but a greater percentage of that payment goes towards interest. Meaning, when interest rates went sky high back in 22 and 23, some people's payments weren't even enough to cover the interest portion, and that was due to the bank. When this happens, the unpaid interest gets tacked onto the principal, and the length of the loan gets extended.
There's no downside here. Really? There's none. It's perfect. Perfect.
And we saw a wave of articles about this back in 22 and 23, with even the Bank of Canada releasing an explainer. Hidden at the bottom of this report was a footnote outlining the real risk with these kinds of mortgages, noting that they will be subject to renewal risk. Mainly, all of that unpaid interest that got tacked onto the principal at the time of renewal would result in a much higher payment. And let's go over a quick example to outline the problem. Let's go back to June of 2021 when variable rate funds advance peaked. We'll use Toronto's data as an example, as even OSFI notes, mortgage delinquencies in Toronto are exceptionally high. Back in June of 21, the benchmark price of a home in Toronto was $1,050,000. Now, I am going to be ultra conservative in these calculations, skewing them to make it seem a bit better than it probably is, as I hate hyperbole and I'm not out to scare, I just want to see where the data is pointing. In July of 21, TD Bank, which coincidentally was shown to have a real problem with these types of mortgages, had a variable rate listed at 1.55. Prime ended up hitting its peak in September of 2023 at 7.2%. So let's assume that buyer of that $1.05 million house put 20% down, meaning a mortgage amount of $840,000, and we'll assume that their trigger rate, the point at which they are no longer making enough payments to pay off any principal, came in September of 2023. We'll pretend that the amortization never went up. It did very much so, but let's be conservative, leave some leeway, which will come in handy later. Now, after 2 years of regular payments of $3,380, that mortgage would now have a balance of $784,000. Let's say no additional principal payments were made. They probably were, but again, we're leaving ourselves some room by assuming no negative amortization. And now when that $784K mortgage comes due in June of 2026 and has to renew, this time at 20 years, that $3,380 payment becomes $4,781, a near 34% increase. Even if the banks decide to let that borrower re-extend their amortization back up to 25 years, which is a big if, considering that benchmark price home is now worth $100,000 less than it was when it was purchased. But even then, that payment comes in at $4,138, a 20% increase in mortgage payments. And just to show that these calculations are in fact being conservative, according to a recent release coming from the central bank, it's estimated that 10% of those borrowers will be renewing with a payment increase of 40%. It's obviously going to differ across mortgages, timing, interest rate, when the home was purchased, but you get the idea. We had a period of time where all of these borrowers weren't making any principal payments, and now all of those payments are going to have to be renewed at a higher interest rate. Okay, so now we know what these fixed payment variable rate mortgages are. We know what the risks are. Now that we know what they are, what exactly is the banking regulator saying? OSFI in its report is noting that it's these guys where we're seeing an increase in delinquencies, noting we observe higher delinquencies in variable rate fixed payment mortgages, and that delinquency levels in Toronto continue to surpass delinquencies in other major centers. There isn't a whole lot of additional information provided, so I emailed OSFI myself for some clarification.
Why?
No, I wanted to ask if it's the pandemic era variable with fixed payment mortgages where we're seeing the concentration in delinquencies. For its part, in its response to me, OSFI did confirm that it is those 21-22 mortgages that are rolling over that is the cause of the delinquencies. In contrast, OSFI also noted that those 23-24 mortgages saw a lot less move into negative amortization, which would make sense as rates were much higher at the time, so the payments started off much higher as well. But then I followed up with the regulator once more, as we really wouldn't be expecting these 2021 mortgages to have rolled over as of yet, so we wouldn't be expecting them to have payment increases. And to their credit, OSFI got back to me in short order. Media, it's really not that hard. Do the research, find the email, inquire, and report back.
Not on my watch.
For their part, and I think this is quite telling, OSFI said that since there were relatively more mortgages in 2021 than there were in 2020, and indeed that is the case if we look at the volume of funds advanced, there are going to be more delinquencies. And it actually does kind of make a bit of sense that some of these 2021 mortgages are going delinquent. As we reported in the past few years, some of the banks got quite aggressive with client outreach, asking borrowers to make increased payments. And if it is those ones specifically that have increased their payments already, because it wouldn't be the other ones, those are the ones still on ultra low 1.5% payments, then I do wonder if this is a sign of things to come, as there was an awful lot of these kinds of mortgages, of these variable rate mortgages, 80% of which the Bank of Canada says were fixed payments, back in 2021. As such, if we are seeing what happens when those payments do get increased, that could be the canary in the coal mine, as not all borrowers are out of negative amortization, even now with all of the interest rate cuts. Taking a look at TD's most recent financials, they still have 7.3% of their mortgage book with mortgages over 30 years. Given that 30 years is the maximum amortization an A lender can give out, then I can only assume all of those over 30 years are the ones that are negatively amortizing. So those guys, that's 7.3% of TD's book, that is just a problem waiting to happen, so long as I'm reading their financials correctly.
You're learning.
Further, and I alluded to this before, I think it's worth noting that OSFI didn't say the 2020 mortgages are going just fine. What they said was that there was a lot more of those mortgages in 2021, meaning those mortgages in 2020 could still be proving problematic. And if we are getting a preview as to what happens when these mortgages roll over, not limited to the variable rate with fixed payment mortgages, maybe even the fixed rates as well, as there's an awful lot coming due, as we can see with the uninsured and insured volumes advanced back in 20 and 2021, then we could very well be in for a rough ride. And finally, what this also tells us, since those delinquencies are concentrated, according to OSFI, with those with variable rates and fixed payments, then it's not the economy that's causing the delinquencies, which means this, thus far, is not the Grandmaster's fault. It's not the economy, as of yet, that's the problem. It's paying for those years of COVID.
That is never going to happen.
Further, and this is just a brief side note, this also comes as, strangely enough, I thought it was strange, that the Bank of Canada came out in public to complain about Canada's banks, which just kind of came out of the blue, calling the banks an oligopoly. We had already done that on this channel with that interview with Andrew Spence at the beginning of the year, but it was a little jolting to see it coming from our central bank, seemingly out of nowhere. It makes me think maybe something is coming. They have data we don't. So, early signs of those delinquencies that we've been discussing for the past few years, we're seeing those early signs, and since they do match up with the data, and the data shows that there's a lot more coming down the pike over the next year or so, we could be in for a rough ride. We will obviously continue to track how this all plays out on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, thanks so much for watching.